Welcome back, students. We are starting with part 2 of Sole Trader now. In this part, we will basically cover year-end adjustments. These are the changes that you have to make to the trial balance given in the question before preparing your income statement and SOFP to simply reflect a true or fair picture of your company's position and performance. These are the adjustments that we are supposed to make. You can pause and look at them if you want to, but I will cover them one by one in this chapter. Let's begin with accruals and prepayments first. Okay. Accruals and prepayments. For now, we are only focusing on the definition of these. Okay. So let me tell you about these one by one. What is an accrued expense? An accrued expense is simply, for example, you have used a service but you haven't paid for it yet. Okay. An expense that has been incurred but not yet paid for. For example, we are in the month of Feb. Okay, let's say we are in the month of Feb. We used internet in the month of Jan. Jan में हमने क्या किया है? हमने internet use किया है. ठीक है? We have used internet in the month of Jan, but we haven't paid for it yet. हमने इसको pay ही नहीं किया अभी तक. What is this for us? This is an accrued expense. We have used the service. We have not paid for it yet. Okay. So it is, in simple words, a current liability for your business. You're supposed to pay this amount in the near future. Moving on to prepaid expense. As you might have understood just by reading this, I hope you know what prepaid means. Prepaid simply means you have paid for something in advance, right? So it's a good thing for you now, right? You have paid for an expense in advance, which means you're in the month of Feb. You have paid the internet expense for March, let's say. Okay. You're in Feb. You have paid for the next month already in advance. So this is your current asset. Till you have used the internet in March, this will remain your current asset in the SOFP of the business. Okay. To show, we have to show everything in accounting. So we will record this as a current asset till we have used this in March, and then when March is over, we can remove this from the current asset section of SOFP, but till we have used this expense, we will record this as a current asset. Okay. In simple words, we have paid for an expense in advance and it is our current asset. Accrued income. Accrued income is, in simple words, let's not read this. Let me explain this in simple words. See, you have provided a service to someone, but you haven't received the payment yet. Okay. Let's say you have a car repair workshop. A friend sent his car to you. You did the maintenance. You also changed his oil. You did everything. Okay. You have provided the service, but you haven't received the money yet. So this is your current asset because you have provided the service. You are waiting for payment. So they become your receivables. You have to receive money from them, right? So this is a current asset in your SOFP. On the other hand, prepaid income. In simple words, you have not provided the service, but you have received money in advance, right? For example, you have given a room on rent and your tenant paid you advance rent for 1 year. So this is your prepaid income. You haven't provided him with the service yet. He hasn't used the apartment or the room for the entire year, but he's paying for that in advance. So this is your current liability. You have to let him use the service in order to make this payment yours, in simple words. So it is a current liability. In simple words, any income received in advance without providing a service. Moving on. Okay. In accounting, we have a principle called the matching principle. The matching principle states that a business should record an expense in the same accounting period as the revenue it helped earn, regardless of whether there was a transfer of money. Okay, I will explain this in simple words, don't worry. ठीक है, let's not read this. I will explain this to you in my own words. Let me just delete this. One second. Previous slide. Okay. See, the question that we get. For example, we have a question. A trial balance is given in which rent expense is given as 10,000. This is the debit side of the trial balance. This is the credit side. Then we have internet expense given as 5,000. Okay. Expenses are always recorded on the debit side of trial balance. If you don't know, go through chapter number 6 first. Your basics should be strong. So remember, don't skip chapters. Okay, in accounting, everything is step by step. If you skip any chapter, you will not understand what's going on. Okay, this is rent expense. This is internet expense. This is your trial balance. Remember, the trial balance shows us the actual payments made for the expenses during the year. These are the actual payments made, which means for rent, I have paid $10,000 or rupees, whatever. And for internet, I have paid $5,000. Okay. This doesn't mean that this was the expense of rent during the year or expense of internet during the year. This just simply shows how much money I actually paid. Actual payment made. Now, at the end of the year, they will give you some additional information. Okay. Additional information. Let's say they are informing us that rent accrued was $1,000. What it means is that after you have made this payment of 10,000, still rent accrued was 1,000, which means you have used the service and you're supposed to pay for it. So what is the actual rent expense of the year? Actual rent expense. The actual rent expense is 10,000, which I have paid already, and then this pending 1,000, which I was supposed to pay, but I'm not paying this amount this year. Even though I'm not paying this amount, the actual rent expense of the current year is 11,000, right? Because this is the amount I paid and this is the amount that is accrued or pending. So regardless of how much I pay, the actual rent expense of the current year was 11,000. So in the income statement, I have to show rent expense as 11,000. This is what the matching principle states. That you don't have to care about how much money you have paid in reality. You just have to show the entire amount of expense or income relating to the current year. Okay. Regardless of how much you paid for it. Even if I paid just 2,000 for rent and my actual rent expense of the year was 20,000, I will record 20,000 in the income statement. Not 2,000. This is the amount I have paid, but this is the actual rent expense. So I have to show the actual expenses. I cannot show only the amount I'm paying for. Remember that. Okay. So one second. So the actual rent expense should be 11,000, and in the income statement I will record rent expense as 11,000. I hope it's clear. Let's do it for one more expense, but this time let's use prepayment as the example. Let me erase this. Okay. In the additional information section, they're also telling us that internet expense prepaid $2,000. What they're trying to tell you is that in this amount 5,000 that you have paid for internet, it includes 2,000 prepayment for the coming year. Okay, which simply means that out of this 5,000 you have paid 2,000 for the coming year in advance, and only 3,000 belonged to this year. So your actual internet expense for the current year was $3,000. Okay, let's say this is 2024, and this $2,000 is paid for 2025 in advance. So in the income statement, should I record the entire 5,000 or only the expense that relates to my current year? I have to record only the expense that relates to my current year. So any prepaid amount, which is 2,000 in this case, will be subtracted from the payment I have made, and then I will write $3,000 and put this figure as internet expense in my income statement. Okay, remember this. This is what the matching principle is. You only include the actual expense or income of the current year in the income statement, regardless of how much you have paid for it. Okay, even if it's accrued, even if it's prepaid, you have to adjust those things and find out the actual amount of expense or income that relates to the current year. I hope it's clear. Moving on. Let me just bring that text back in case someone wants to use these slides later and I have to upload them. Okay, now let me read this. Let's read this now. The matching principle states that a business should report an expense in the same accounting period as the revenue it helped earn, regardless of whether there was a transfer of money. See, it recognizes that expenses and income should be included in the financial year to which they relate, even if the expense was not paid or the revenue was not received. Similarly, expenses and income prepaid should not be included in the year in which they were paid. Okay, so that's what I explained to you. Moving on. Okay, accrued expense is added to the value given of the expense in the question, just like I showed you in the previous slide. It is also recorded as a current liability in SOFP. I have told you why. Prepaid expenses are subtracted from the value of the expense given in the question and is recorded as a current asset in SOFP. Okay, you can read all this. I have told you about this already in detail. But remember, accrued amounts are always added. A for accrued, A for add. Accrued amounts are always added to the values given in trial balance. And prepaid amounts are always subtracted from the values given in trial balance. You can just remember it like this. Okay, accrued income or expense, both are added to the amounts given in the trial balance, and prepaid income / expense is subtracted from the amounts given in the trial balance. Okay, accrued expense and prepaid income is a current liability, whereas prepaid expense and accrued income is a current asset, and I have told you why as well in the previous slides. Moving on. Okay, this is a question now. This is how you get a question. So see, there's a lot of information given in this question. This is a trial balance, as you can see, trial balance. So they've given you a list of all the balances. I hope you know what a trial balance is. Chapter 6, remember? Okay, so additional information. Inventory at 31st December was 89404. This is your closing inventory. But right now I'm dealing with only accrued and prepaid adjustments. So let's read them first. Insurance expense 45 was accrued. Okay, so what should I do? I will have to add 45 and make this amount 745. Okay, because for insurance I have paid 700 and 45 is still unpaid, accrued. So my actual expense for insurance during the year is $745. So I should record this amount in the income statement to show the true value of the expense belonging to the current year. Again, accrued expense is a current liability. So when I prepare my SOFP, I have to remember to include $45 as a current liability in my SOFP. Okay. Office expense $8 was prepaid. Okay, let's find office expenses 400. I have to subtract $8 from it and get 392. Okay. See, for office expenses I have paid $400, but I have prepaid, which means $8 out of this belong to the next year. I have paid for in advance for the next year. So the actual expense of the current year for office expenses is $392, not $400. So in the current year's income statement, I have to show this value. Okay. And that $8 will become my current asset in the SOFP. Commission income $50 was accrued. Okay, an accrued income. Accrued income means you have provided the service but you haven't received the money yet. What's the value of commission income? First of all, it's 100. So I will have to include 50 more to this and make this amount 150. Why? Let me tell you why. I have received $100 for commission. Okay. And commission income, see, this amount in trial balance shows how much money I actually received. So I have received $100 for commission income, but 50 more was accrued, which means I have provided the service, but I'm yet to receive 50 more dollars. In reality, what's my income? What's my commission income for the current year? It's $150, not $100. So in the income statement, I have to show this as 150, the actual income of the year, right? And then it is an accrued income. And accrued income is always a current asset because you are supposed to receive the money. It's a receivable, right? And why is accrued expenses a current liability? Because you're supposed to pay. It's a payable. A prepaid expense is a current asset because you are yet to receive the service. You've paid for in advance, right? So see, receivables and payables. Payables are your liabilities. Receivables are your assets. Okay, so I have made the changes. I will put the new values or the adjusted values. This is what we call making adjustments. I made adjustments to the value of expenses and incomes given in the question to find the new values or the actual values of the expenses and incomes which I have to use in the income statement. Right? Okay. Let me erase this and move on. Okay. This is an advanced level adjustment for accruals and prepayments. See, these adjustments are simply given. They're telling us the accrued amount, the prepaid amount. So this is simple and very, very basic. But usually they also give you one adjustment like this. This is the adjustment in which you have to figure out the prepaid or accrued amount and then do the same thing which we were doing in the previous slides. So let me make it simple for you. See, first of all, as you can see, this trial balance is extracted on 30th April 2017. Okay. See, an accounting year can be any 12 months. Accounting year can be any 12 months because all the businesses will not start on 1st Jan and then the year will not always end on 31st December. Right? You can start the business in any month. Right? You don't have to wait for Jan to start your business. So let's suppose you started your business on 1st March. When will your accounting year end in that case? Will it end on 31st December? No. You have to count 12 months. March, April, May, June, July, August, September, October, November, December, Jan, Feb. So your accounting year will end on 31st Feb in that case. So an accounting year can be any 12 months. Okay, remember that. Now, this accounting year is ending on 30th April. Okay, we know that just by looking at this. The dates are always given. Let's look at the previous example as well and see. See, the date is given. So in this case, It was ending on 31st December, which is fine. But this is also fine because the accounting year can be any 12 months. So your year can end on 30th April 2017. So don't worry about these dates. This is just the last day of the accounting year. Okay. And if you go 12 months back, you can also figure out the date, the starting date on which your accounting year started. Simple. Okay, let's read the adjustment now. The rent payable included a payment of 12,000 for 6 months. Okay. Ended 30th June 2017. Okay, so we have made a payment in this 24,000. There is an inclusion of a payment of 12,000, which is for 6 months, and the payment is supposed to end on 30th June. Okay, so go 6 months back from June. Jan, Feb, March, April, May, June. In simple words, this payment is from 1st Jan till 30th June, right? This is for 6 months. Now, our accounting year ends on 30th April. Okay? 30th April को हमारा accounting year क्या हो रहा है? End हो रहा है. So from 30th April till 30th June, we have 2 months, right? April के बाद May and then June, which means in this 12,000 there is a prepayment of 2 months included. Okay, in accounting, we cannot record prepayments in the current year's income statement, so we have to remove the 2 months prepayments from this amount given here. How will we do that? See, the payment is $12,000. Okay, it is for 6 months. This 12,000 is paid for 6 months, out of which 4 months belong to the current year and 2 months are the prepayment for next year. Okay, so 12,000 divided by 6 will give me the monthly payment of rent, which in this case will be $2,000. Basic math. Okay, so $2,000 is monthly payment of rent, and we know that we have paid for 2 months in advance. How? Our accounting year is ending on 30th April. We have paid till 30th June. So April के बाद May, June, 2 months. So 2 months का कितना बना? It is $2,000 monthly. So for 2 months, the prepaid amount would be $4,000, right? So simply subtract $4,000 from the amount of rent payable given in the question, because this amount shows the money paid during the year, but in the income statement we have to show the expense relating to the current year only, which is 20,000. Okay, out of this 24,000, 4,000 is paid for in advance for the coming year, and we have worked that out. So only 20,000 belongs to the current year. So in the income statement we can only show rent expense as 20,000 and not 24,000. This is the adjustment that we have to make by reading only this information. Okay, now that 4,000 is prepaid expense, and I've told you a prepaid expense is actually a good thing for our business, so we include this as a current asset in SOFP. That's it. This is how you deal with such adjustments. Okay, moving on. Okay, depreciation. We are only focused about the adjustments necessary for depreciation. Okay, depreciation is covered in detail in chapter number 11. I have made 2 parts for that. You can go through that if you want to know about depreciation and what depreciation is, etc. In this chapter, I will only discuss how to make adjustments based on depreciation. We have 3 methods, as you know: straight line, reducing balance, and revaluation method. In straight line method, the formula to calculate depreciation is cost multiplied by rate, the percentage given in the question. Okay. In reducing balance method, the formula is net book value multiplied by rate. And revaluation method, as you know, is just opening value, add any purchases during the year, and then subtract closing value. This is how we get depreciation using revaluation method. I'm just revising the formulas with you. I'm not going into the details. If you want to know the details of depreciation, go through chapter number 11. Okay, open that video first. Let's move on. Okay, so as you can see, they have given us the cost of our non-current assets. In this question, we have 3 non-current assets, as you can see: motor vehicles, computers, fixtures and fittings. Okay. Their provisions for depreciations are also given, which are 12,000, 17,000 and 4,000. Okay. Cost is the value for which you have purchased them, right? And these provisions for depreciation, in simple words, is the total depreciation till date. How much value they have lost till now. Okay, this is what provisions for depreciation is for. This is to show you how much value your motor vehicle, your computers and fixtures and fittings have lost during the years. Okay, so in simple words, your motor vehicle, which had a cost of 40,000, has depreciated by 12,000 till now. So what's the actual value of your motor vehicle right now? It's 28,000. That's the net book value, or the actual current value of your motor vehicle, right? This is the depreciation, the value it has lost till now. So this is your net book value, or the actual value of your motor vehicle. Now let's read the adjustments and how they are given in the question. Depreciation is to be charged on all non-current assets owned at the end of the year as follows. Motor vehicle at the rate of 20% using diminishing, which is also called reducing balance method. Okay. Then we have computers at the rate of 25% using, again, diminishing or reducing balance method. And then fixtures and fittings at the rate of 10% using straight line method. So straight line method is actually faster and easier. These are also pretty simple if you know the format, if you know the formula. Nothing is difficult in this. You should be knowing the formulas of both the methods by heart. So see, let's depreciate our motor vehicles first. I'm doing the working for the first one. Reducing balance method. The first thing you should know is the formula to find depreciation using reducing balance method. It is simply net book value multiplied by rate. Rate is the percentage given in the question. As you can see, in this case it's 20%. Okay, what is net book value? Net book value is the current value of your non-current assets, which we can easily find by subtracting provisions for depreciation from cost. Just like I did. Let me show that to you again. What's the cost of motor vehicle? It's 40,000, as you can see given in the question here. What is the provision for depreciation? It is 12,000, as you can see given in the question here. So the net book value is 28,000. Okay, that's the net book value. Where's my calculator? Okay, I can use my phone. 1 second. Okay, so net book value is 28,000. We are working for motor vehicle. Net book value is 28,000. The rate at which we have to depreciate this is 20%. Use your calculators. 28,000 multiplied by 20%, you will get 56 This is the depreciation of motor vehicle. Okay. What do we do with this amount? How do we record this in statements? Okay, remember, this will be recorded as an expense because depreciation kya hai? Depreciation is an expense for the business. Expense in income statement. So while you're preparing the income statement, make sure to record this as an expense. You will simply write depreciation of motor vehicle and the amount 5600 in front of it in the expenses section of the income statement. Then also remember one more thing, which is to include the current year's depreciation in the provision given in the question. Okay, I will tell you why in a moment. Let's add first. So 12,000 plus 5600 gives me 17,600. Why did I add this amount to the provision given in the question? Because this 12,000 is the depreciation till date before calculating the depreciation of the current year. Once you have calculated the depreciation of the current year, it's your responsibility to also include this amount so that we know the new total depreciation, because we will have to record our non-current assets at net book value in SOFP of the current year. For that, we need the new amount of provisions. You will get to know that when I solve a past paper question just now, after we are done with all the adjustments. But for now, remember this. You have to include this amount in the provisions and also include this as an expense in the income statement. Let me erase all this and move on to the next non-current asset, which is computers. So even if this was unclear, watch again. We are doing the same thing because it's the same method, only the percentage is changing. So pay attention. Okay. We are using reducing balance method again. What are we depreciating now? We are depreciating computers. Reducing balance method, the formula is net book value multiplied by rate. Let's find the net book value first, which is simply cost minus provision for depreciation. Okay. So the cost of computers is 55,000 given in the question here. And then the provision for depreciation for computers is 17,000 again given in the question. So as you can see, everything that we need is given. It is very basic. So 55,000 minus 17,000 gives me 38,000. This is the net book value. Once you have the net book value, put it in the formula of reducing balance method to find the depreciation, multiply it by the rate given in the question, 25%. You will get the value of depreciation for the current year, which in this case is 9,500. Okay, this is the depreciation of computers. Okay. Remember to include this as an expense in the income statement, and then also include current year's depreciation, which is 9,500, to the provisions given in the question. 17,000 plus 9,500 gives me 26,500. Okay, so I will record this in provisions because I need this new value for SOFP. You will get to know why. Let's move on to the third one. Okay. Fixtures and fittings at the rate of 10% per annum using straight line method. Straight line method is actually easier than reducing balance method because we skip one step. We don't have to find the net book value, as the formula is simply cost multiplied by rate. In this we ignore the provisions, okay, because we are just applying a rate on cost. So the cost of fixtures and fittings is 15,000. Okay, they've asked us to use straight line method, so that's what we are doing. And then the rate is given in the question, 10%, which will make it 1500. This is the depreciation of fixtures and fittings, which you have to record in the income statement as an expense. And make sure to also include 1500 here to the provisions and make them 5500, because we require this figure in SOFP. Okay, that's it. So this is how we do the workings for depreciation. We record the current year's depreciation as an expense in the income statement. Okay, I'm repeating one more time. Listen carefully. Once we find the depreciations, we have to record the current year's depreciation as an expense in the income statement, right? And then also include the depreciated amount in the provision for depreciation given in the question, because we will have to use the new figures in the SOFP. Okay, moving on to bank loan and bank loan interest. Okay, in questions you will usually have one of these given. Okay, so let's read this. K is a sole trader. The following balances were extracted from the books on 30th April. They have given us a bank loan, okay, which is repayable in 2022. We are in 2017, as we can see, and this loan is payable in 2022. So just by reading this, we know this is a non-current liability, right? Now, what is this 5% given? This 5% is the interest rate, the yearly interest, which you have to pay on this loan. When you take a loan from the bank, you have to pay yearly interest. This 80,000 you will pay as it is on 30th June 2022. You have to pay this entire amount as it is to the bank, but on top of that you have to pay an yearly interest of 5% on the amount you have taken from the bank. Why will a bank give you a loan? The only reason they give you a loan is to charge interest from you. They want to generate money. Okay? So if there is no interest, a bank might not be interested in giving you the loan. So this is the yearly interest rate. This is the rate. So to find the yearly interest, all you have to do is multiply the rate with the amount of loan. This will give you the yearly interest payable on the bank loan. So let me do this. 80,000 into 5%, it is 4,000. We have to pay $4,000 every year as interest to the bank. This 4,000 is your expense. Interest क्या होता है? Interest is an expense. So we have to include this in the income statement for the year. Okay, that's the first thing you're supposed to do. Then in the SOFP, you will record this 80,000 as a non-current liability. Okay, that's the second thing you have to do. Furthermore, they've given you something else here as well. They told you that bank interest paid is 2,500. Okay, this is only given to show you, this is not given to show you that you record this 2,500 as bank loan expense in the income statement. No, that will be wrong. This is not the bank loan interest. This is wrong, right? The bank loan interest is 4,000. So in the income statement, we are supposed to record this at 4,000, regardless of how much money we have paid. Again, matching principle. ठीक है. The actual expense of the year comes in the income statement, not the amount paid. They're just trying to tell you that out of this 4,000, one second, let me change the color here. They're trying to tell you that out of this 4,000, you have paid 2,500. Which means 1,500 interest is still unpaid. It is accrued. And you know, accrued expenses are your current liabilities. So they simply want you to know that you have to include 1,500 as a current liability in SOFP, because the actual interest expense is 4,000, out of which you have paid 2,500. Okay? So the amount that is still unpaid is 1,500. So record this as a current liability in SOFP till you pay this amount. Okay? This is what we do. But in the income statement, we record the actual amount of expense belonging to the current year, which is $4,000. Okay, simple. It will be clear when I do this again in the past paper question. Moving on. Irrecoverable debts and provision for doubtful debts. Okay. We also have to make adjustments for these. Irrecoverable, from the word you can understand, irrecoverable means you cannot recover that debt anymore from your trade receivables. Who are trade receivables? Trade receivables are those people who owe us the money. Okay? So when they don't pay us back, in any case, let's say they went bankrupt or they're no longer traceable, they ran away with your money or things like that. That is called an irrecoverable debt, which means they're not going to pay you that money back. Irrecoverable debt. This was also called bad debt in the past. Okay. This is an expense for the business, right? When they're not going to pay you, how will you include this amount? You will include this amount as an expense of your business. So it goes in the income statement. Okay? That's the first thing. This is the amount that you cannot recover from your trade receivables. Okay? It usually happens in businesses. Some of your trade receivables might not pay you back, depending on a lot of reasons. There might be a lot of reasons. For that, you can think of those reasons. One reason is that the business went bankrupt, so they can no longer pay. They don't have the money to pay. In that case, it is an irrecoverable debt. Okay. So let's see. This is how the question is given. There are a lot of things usually given in the question. We only have to focus on trade receivables and provision for doubtful debts for this adjustment. Okay. So let's read. Trade receivables of 2,700 are irrecoverable, which means out of this 44,700, we are not going to receive $2,700. We are not going to receive that money. So simply bring the amount of trade receivables down to what you're going to actually receive from them, 44,700 minus 2,700. So my actual trade receivables are worth $42,000 now, right? Because I know this is irrecoverable. I cannot receive this money from them. So I will adjust this and make the amount accurate, which is what I have to receive from trade receivables now. Okay, so where should this 2,700 go? This will go in the expenses section of your income statement as irrecoverable debt. Okay. When you're listing down all the other expenses, you will also list 2,700 irrecoverable debt in the expenses section of the income statement, because the business will consider this as an expense of the business now, right? Okay. Now let's look at provision for doubtful debts. Okay. See, let me read this first and then explain in my own words. A provision for doubtful debts is an estimate of the amount of trade receivables that a company anticipates will not be collected. Okay. For example, your trade receivables are 40,000, but your company knows that out of this 2,000 will probably not be received. Okay. So this is your provision for doubtful debts. But you know from past experiences that out of this 40,000, we will not receive around $2,000. This is a provision. This is an estimate. You're anticipating that this amount will not be collected out of your trade receivables. Okay, how do you anticipate or prepare this amount? Using your past experiences. You have your business from, let's say, 5 years, 10 years. You know how much out of trade receivables is actually unpaid. Okay, so it is usually given as a percentage, 5%, 10%, and so on, and then we find the provision for doubtful debts amount. Okay, what do we do with that amount is what I'm going to tell you in the adjustment. Okay, we have to follow accounting principles which state that assets should not be overstated and also profits should not be overstated. We have to foresee these things and manage them in the accounting books. It is a contra asset account. A contra asset account is an account which reduces the value of our assets, in this case trade receivables. Okay, now let's read this again. We were done till here. The provision for doubtful debt is to be maintained at 5% on the remaining trade receivables. Okay, so what was the value of our remaining trade receivables? Remember, we subtracted 2,700 out of this to get 42,000. This is the value of the remaining trade receivables. So we have to apply 5% on this. What will we get? I think 2,100, but let me double check. Always double check. Okay, make sure you don't make mistakes. You will lose marks for no reason if you make these basic mistakes. Yes, it is 2,100. This is the provision for doubtful debts. You expect your trade receivables to not pay you this much out of the 42,000. Okay, so when you're preparing your SOFP, in the current asset section, when you record your trade receivables as 40,000 here, make sure to deduct the provision less provision for doubtful debts from it to get the actual value you expect to receive from your trade receivables, because we cannot, sorry, this is 42,000, because we cannot expect or we cannot overstate our assets. In accounting, we cannot overstate our assets. If we expect something to happen, we have to account for that, and we are doing that. Let me write this clearly. Okay, 42,000 minus 2,100 gives me 39,900. So in my current asset section, I will record trade receivables as 39,900, not 42,000. Okay, make sure you deduct the provision for doubtful debts from it. You have to do that always. Okay, we have to follow accounting principles. Now, what do we do in the income statement then? See, the current year's provision is 2,100. This is the end of the year value. At the start of the year, we also had a value of provision for doubtful debts given in the question. This is always given in the question, unless it is the first year in which you are creating the provision. Okay? If it's the first year and this was not given, let's suppose, then in the expenses, I will simply write provision for doubtful debts and the amount will be 2,100. This is also an expense of the business, right? Okay? But in this case, we have a previous figure of provision for doubtful debts, which means this part is already recorded as an expense of the business. Okay? Previously. So now your provision has changed to 2,100 from 1,400, which is a bad thing. Which means previously we were expecting our trade receivables not to pay us 1,400, but now we are expecting them not to pay us 2,100. So the provision has increased by 700. This is bad for us, right? So I will record only the increase in provision, which is $700 in the expenses section, I will write increase in provision, because this was previously recorded as an expense already. So I will only record the change in provision. Okay, so this is how I will record this as an expense. This is the correct working for that. Now, let me give you an example. Okay, let's suppose our provision, this is the previous provision value 1400 opening value, and let's say at the end of the year when we calculated, our value was coming as 1000 for provision of doubtful debts. Okay, in this case the provision has actually decreased by 400. This is the decrease of 400, right? We expected our trade receivables not to pay us 1400. Now the figure has reduced to 1000. We expect them not to pay us 1000. So this is a good thing for the business. The provision has decreased by 400. In that case, we will not record this as an expense, but you remember I told you about the other income section of the income statement. In part 1, we will record this as a decrease in provision for doubtful debts, and the amount will be the actual decrease, which is $400. So in that case, it will be our other income. So if the amount is more than what is given for provision in the question, it is an expense and it is increase in provision. If the amount which you find is less than what was given in the question, it is a decrease and it should go as an other income. Okay, moving on. Errors. Okay, in the question they will give you some errors. They can give you 1, they can give you 2. In some questions I've also seen 3 or 4 errors mentioned, so we have to correct them as well. These are very easy and they are corrected on the go. There's no fixed format for that. You should just know the double entry system of accounting, which is chapter number 3. If you know what to debit, what to credit for a transaction, you can easily fix these errors. Okay, so let's read this as an example. On 16th April, goods had been purchased for 7500 cash. The transaction had not been recorded in the books. Okay, in simple words, we purchased goods and paid by cash and did not record it in our books. So what should we do? We should add 7500 to purchases, right? Because apart from these purchases, we had purchased more goods which we forgot to record. So 204,400 plus 7,500. The actual value of purchases should be 211,900. And you know where we use this value in the income statement? In the cost of sales section. So when you are preparing the income statement cost of sales section, you will take this amount as purchases, not the one given in the question. That's why we are making adjustments, so that we can use the new figures, right? And then what will happen with cash? You're paying by cash, which means cash will decrease. When you pay by cash, your cash decreases. So minus 7,500, 15,400 minus 7,500 gives me 7,900. So this is the new value or actual value of cash in bank available with the business. Okay, we forgot to record this. Once we record this, this is the actual or real value. So when I prepare my SOFP, when I prepare current asset section, you know cash and bank, both of these are current assets. I will record them at 7,900. Okay, the adjusted value, not at 15,400. That would be wrong. So we have to show the actual or real amounts in these statements. That's why we make adjustments to the trial balance before making the income statement and SOFP, so that these changes are included. Okay, I think that's it for the adjustments. Let's move on to the question now. Okay, let's begin with the past paper question now. So this is how you will be getting a trial balance in the question. This is the list of final balances of all my T accounts. If you're not aware of what a trial balance is, please go through chapter 6 first. They will not ask you to make a trial balance in this, but they will just give you the trial balance, okay? And then they will give you some additional information. which you have to use to make changes to this trial balance and then make the income statement and SOFP with the new values, not these values. Okay. So these are the additional informations given at the end of the year. You can see 7 of them are given. We have to make adjustments by looking at them. I have done this with you in the slides. Okay, I used examples from this one only. So let's just complete the question now. This question was of 40 marks. 20 marks are for income statement and 20 marks are for statement of financial position, SOFP in short. Okay, this is a 40 mark question. You no longer get 40 mark questions in your CAIE exam because the pattern has changed. Now the maximum marks for any question are 20. So you will not get such a detailed question in which you have to make the complete income statement and SOFP, but they can ask you to make any one of these or one part of income statement and one part of SOFP. So you should know the entire thing. That's why these 40 mark questions are very good for practice because they cover everything you need for this topic. Okay, so we still use them to practice the income statement and SOFP with adjustments. So we will be doing this one. Okay, this is the list given. You can see revenue, purchases, return inwards, all these things are given. So the first thing I tell my students to do is to identify each one of these and where will they be used. So let me show you how. Let me zoom this in first. Let's move it here. Okay, so what is revenue? Revenue is simply another word for sales, and you know where will I use this? In the income statement. Okay, purchases, again income statement, cost of sales section, right? Return inwards are the goods that you sold and they're coming back to you. These are your sales returns in simple words. Sales returns. And then these are also part of your income. One second. Let me zoom this in more so that I can write properly. Let's do this again. What is revenue? Revenue is another word for sales. And you know this is the part of your income statement. What are purchases? Purchases are your cost of sales. You know the format from part 1 of Sole Trader. If you don't know, please look through that video before moving on to this. Return inwards. The goods are returned back to us. Return inwards. These are your sales returns. And again, they are part of your income statement. Wages and salaries. This is an expense. Expenses are always recorded in your income statement. Motor vehicle expenses, again an expense. So we can just write E and then income statement if you want to write. I'm just showing you how you can make it simpler for yourself so that when you're solving the question you can do it quickly. Okay, if you make these changes once, they will help you throughout the income statement and SOFP. Things will get faster for you. General expenses, again it's an expense. Now I'm not writing income statement anymore. We should be knowing that expenses are part of income statement. Okay, if you don't know, please go through the video of part 1 of Sole Trader. Rent receivable. Receivable, it is an income. It is not an asset, it is an income. Okay, the money that we receive from other activities of the business. Rent payable is an expense. Motor vehicle at cost is a non-current asset. Computers at cost, again non-current asset. Fixtures and fittings, non-current asset. So these are part of your statement of financial position. Because in SOFP, what do we have? In SOFP, we have all the assets, all the liabilities, and all the capital of the business, which includes drawings and profit for the year. In the income statement, what do we have? In the income statement, we usually have all the incomes in which sales is also included, and then all the expenses of the business, okay, in which cost of sales is also a part, but we deal with sales and cost of sales on top of the income statement in the trading section. And then we mention all the other incomes and expenses of the business. So in a way, income statement contains incomes and expenses of the business, whereas SOFP contains assets, liabilities, and capital of the business. Okay. Erasing this and moving on. Provision for depreciations. This is the value your non-current assets have lost over time. This is their total depreciation till now. So this is also part of SOFP in a way. I will tell you how and where to record this. Moving on. 5% bank loan. Okay. Repayable 30th June 2022. The first thing you will do is look at the date. Okay. Our accounting year is ending on 30th April 2017, which means we are in 2017 right now. This loan is repayable in 2022. So this is your non-current liability. You should be knowing what non-current and current liabilities are. Okay. Bank interest paid. This is just info so that you can figure out how much amount is still to be paid from the bank loan interest. Inventory at 1st May 2016. Okay, remember, in these questions, we will be given two types of inventories. Opening inventory. You know what opening inventory is. I have discussed this in detail with you in the previous videos. So we will have opening inventory and closing inventory. Opening inventory is always given in the trial balance. Closing inventory is not given in the trial balance. It is never included in the trial balance because it is already part of opening inventory or purchases, as discussed when I was telling you about cost of sales in, I think, part 1, the video of part 1 of Sole Trader. So go through that. So opening inventory is given in the trial balance. This is the trial balance. So this one is your opening inventory. Okay? And the one given in additional information is your closing inventory. This is your closing inventory. Okay. You can also double check by looking at the dates. The earlier date is always the opening inventory and the later date is always the closing. So this one is given at 30th April 2017. This inventory is given at 1st May 2016, which is the earlier date. This obviously. So the opening inventory is given at the start of the year. Our accounting year is from 1st May 2016 till 30th April 2017. So obviously the value given at the start is opening inventory and the value given at the end of the year is closing or leftover inventory. You can count. These will be 12 months for sure because our accounting period is always of 12 months, right? So two ways of knowing. First is that opening inventory is always given in the trial balance, whereas closing inventory is not given in the trial balance. Secondly, you can look at the dates. The earlier date is always your opening inventory and the later date is always your closing inventory. And that's the better way to check. Okay. It will help you in other questions as well. Look at the date. The date is very important in accounting. Make sure you always pay attention to the dates. Okay, moving on. So in this question, we have opening inventory and closing inventory given. And I have marked them. This is opening. One second, let me remove this and mark this as opening inventory. You know, where will it go? It will go in the cost of sales section. And closing inventory is also part of cost of sales section. And it is also a current asset because this is unsold inventory. We remove this from cost of sales section. I have told you why. And include it as a current asset in SOFP. Heat and light, again an expense. Cash and bank, current asset. Trade payables, current liability. Trade receivables, current asset. Provision for doubtful debts. I have told you why it is given in the question. This is just for information to show you the opening value of provision, so that you can compare it with the new value which you will find after the adjustments. This is capital given, again SOFP, and drawings are also part of SOFP, as you know. If you don't know why I have marked these as current asset, current liability, current asset, you should go through chapter 2 and 3 and build your basics first. Okay. Once I'm done marking all these things, the next thing I tell my students to do is make a rough column here for current assets. So you give the heading current assets and leave some space. Then leave some space and write current liabilities. Then expenses. This is your rough work. Okay, you can do this here or you can do this on a rough sheet if or the extra pages that are given at the end of your paper. And then other income. Sorry, leave some space because there are usually lot of other expenses that we have to include in our rough work. So other income, and that's it. Okay. When I will read the adjustments, I will also fill these so that when I make my SOFP and income statement, I remember to put these in my statements. Otherwise, I might forget. So it's better to make a rough column like this for these things so that we can put them in these statements later. I will show you how this will help us. It is not necessary or mandatory. There are no marks for doing this. This is just to help you. Zooming this out and moving on to the adjustments. The first adjustment we can see is that they have told us inventory was valued at 32,450. This is the end of the year value of inventory. So this is our closing inventory. Make sure to record this as a current asset right now in your rough working section. So I will write inventory. And I will also write the amount, which is 32450. Closing inventory is our current asset. You should be knowing that by now. This is the inventory that is left unsold at the end of the year. Okay. Now, I'm done with adjustment number 1. This is just information based adjustment. They were telling us the value of closing inventory. Second adjustment. On 16th April 2017, goods had been purchased for 7,500 cash. The transaction had not been recorded in the books, which means we forgot to record this transaction in our accounting records. So what should we do? We purchase goods. So 7,500 should be added to purchases, and then we paid for these purchases by cash. So 7,500 should be deducted from our cash. That's what we have to do now. We have to make the adjustment. So let's make the change. Add 7,500 to purchases first of all. Purchases are given here. I will add 7,500 to this, and I will get the new value of purchases, which is, let me calculate. Always use your calculator. So this value will become 211,900. This is the new value of purchases, which I will use in the income statement cost of sales section. Okay. Now, I also have to deduct 7,500 from cash. Cash and bank is given combined in this question. It doesn't matter. So we will just deduct the amount from here. Minus 7,500. So 15,400 minus 7,500 gives me 7,900. So I will remember to use this value for cash and bank in the current asset section of my SOFP. Okay. We are done with the second adjustment. We have made the changes necessary to the question. Okay. General expenses were accrued 3,500 and prepaid 1,800. So there's one expense that is accrued as well as prepaid. General expenses might include a lot of miscellaneous expenses together. Okay. It might be that stationery is in it and cleaning is in it. So one of that expense is accrued and the other one is prepaid. In simple words, what do we do for accrued expenses? I have told you, you simply add the amount given to the question. So let's find out where general expenses are and add 3,500 to it. Okay, general expenses, there they are, 31,100 given in the question. Accrued amount is added. So I will add 3,500 to it. And then at the same time, some general expenses are also prepaid. So prepaid को हम क्या करते हैं? Prepaid amounts are subtracted. So I will subtract 1,800 from this. So what will the value of my general expenses be in that case? Let's figure out. 31,100 plus 3,500 minus 1,800. The value is going to be 32,800. So when I'm recording my general expenses in my income statement, I will not record those at 31,100. I will record them at the new value, which is 32800. Let me box this so that we remember. Always use the new values. That's what adjustments are for. Why are we making changes to this? To use the new values to prepare proper statements. Okay. Now let's see what else. Okay. So I have also told you that any accrued expense is a current liability. So we can write here general expenses accrued, and you know the accrued amount was 3,500. Why am I writing this in rough here? So that when I'm making the SOFP, I remember this adjustment. Otherwise, I might forget. I've made the change here, but I might forget to record this as a current liability in SOFP. So this rough work will help me during that time. Okay, you will see how. And then we have general expenses prepaid 1,800. A prepaid expense is a current asset. So I will write here general expenses prepaid and the prepaid amount, which is 1,800. Done. I can tick this adjustment as done now. So remember 2 steps. Accrued amount is added to the amount given in the trial balance. Prepaid amount is subtracted. Then also include them as a current asset or liability depending on what they are. And I've told you about those in this chapter only, in the second section when I was discussing accruals and prepayments. So go back if it's unclear. Fourth, rent receivable of 4,500 was owing. Okay, remember owing, pending, and such words, they all mean accrued. Accrued means unpaid, pending, owing. Okay? So don't worry about this. This is just simply accrued rent receivable. Accrued. So what do we do with accrued amounts? I've told you accrued amounts are always added. So let's find rent receivable and add 4,500 to it. Rent receivable. Okay, it's here. 8,500. I will add 4,500 to this and bring this amount to 8,500 plus 4,500. My rent receivable is 13,000 now. And I will box this to show that this is the new value that I have to use in the income statement. Okay? One more thing. Whenever there is an accrued income or expense, we have to include this either as a current asset or current liability depending on what it is. Is it what we are supposed to pay or we are supposed to receive? See, rent receivable of 4,500 was accrued. It means that you have provided the service, you are waiting to receive the money. So in that case, it is your receivable, it is your current asset. You will write rent receivable accrued and then the accrued amount, which is 4,500. So I will write here rent receivable accrued. Let's write in short because we know this is our rough work. Or never mind, I have space. And the amount is 4,500. See? This is how you record things, right? Let's move on. Let me take this one as done as well. We have just done this adjustment in the example I gave you in these slides, but let's do this again. The rent payable included a payment of 12,000 for 6 months ending 30th June. I will do this quickly now. If you don't know how to do this in detail, please go back and watch it again. But now I will do this how you're supposed to do when you have enough practice. All you have to do is look at this amount. It is 12,000. This payment is for how long? It's for 6 months. So you can find the monthly payment by doing this. This is monthly. Okay. I have paid this amount for 6 months ending 30th June. When is my accounting year ending? On 30th April. Here I'm making a star here. 30th April. This payment is till 30th June. So 30th April to 30th June, we have 2 months, which means this amount includes a prepayment of 2 months. So my prepaid rent in this case would be 2, which is 2 months multiplied by 2000. The monthly rent charge is equals to 4,000. So if I do the working properly, in simple words, they are trying to tell me that prepaid rent is 4,000. Prepaid rent payable, which means I've paid in advance for next year's rent. Okay? I've paid for 2 months in advance. So I cannot include this 4,000 as an expense of the current year. Okay, erasing all this. So this 4,000 is prepaid expense. What do we do with prepaid expenses? We simply subtract the amount given in the question. So where is rent expense given? Rent payable 24,000. I will deduct 4,000 out of this. So my rent payable for the current year is 20,000. That's the expense belonging to the current year. And what do we do with prepaid expenses? We record them as a current asset in SOFP. So I will write here prepaid rent and then the amount 4,000. This is my rough work so that I remember to include this in SOFP. Let me take this because this is done. Moving on to depreciation. We have calculated these in this chapter only. You can go back and see the working in detail. Oh, never mind. Let's do this again. Depreciation is charged on all non-current assets at the end of the year as follows. Motor vehicle using reducing balance method. Computers using reducing balance method, and then fixtures and fittings using straight line method. Okay, so we know the formula for it. Let me zoom this out. We know the formula for let's make 3 columns here to find depreciations. Okay, I will find the depreciation for motor vehicles here. Okay, so let's do the working for depreciation of motor vehicles first. This is our rough work, so I can use shortcuts here, right? Reducing balance method. The formula is net book value multiplied by rate. How will I get the net book value? By simply subtracting provision for depreciation from cost. Let's go up and look at the cost of motor vehicle and provision for depreciation of motor vehicle. So the cost of motor vehicle given in the question is 40,000. I'm making a star so that you can see. And the provision for depreciation of motor vehicle is 12,000. So I can find the net book value. 40,000 minus 12,000. The net book value is 28,000. Okay. Now I can put this value in this formula, net book value multiplied by rate. 28,000 multiplied by, what's the rate of depreciation? 20%. This will always be given in the question. So 28,000 into 20% gives me 5,600. 5,600 is the depreciation of the current year of motor vehicle. So what changes do I have to make? I have to include this as an expense in the income statement first of all. So I will write depreciation. This is my rough work, so I can use shortcuts. Motor vehicle and then the amount 5,600. So that I remember to include this in the expenses section of the income statement when I prepare the income statement. Okay. Okay. Now, one more thing. Also, add the amount to the provision given in the question. So 12,000 was the provision for depreciation till now, which means this was the total depreciation till now. Now it has depreciated furthermore by 5,600, which brings the total depreciation value to plus 5,600, 17,600. Okay? This value was the depreciation before this year. This is the current year's depreciation. We add both to get the total depreciation till now, right? We need these figures to use in the SOFP. So we have to make this. Okay. Let's depreciate computers now. Computers. Again, which method are we using? Reducing balance. We know the formula. Net book value multiplied by rate. I have told you how to get net book value now. It is simply cost minus provision. So I'm simply using brackets here and putting the net book value in this, and then multiplied by the rate given, which is 25%. Okay? One second. Let's find the net book value quickly. Cost of computers is 55,000. As you can see, I'm making double stars on this. This is the amount, 55,000. And its depreciation till now is 17,000. So use your calculator directly and find the net book value. 55,000 minus 17,000 gives me 38,000. So that's the net book value. I will come here and write 38,000. Okay, do the working. Multiplied by 25%, you will get 9,500 as the depreciation. Repeat the steps. Include this as an expense in the income statement. So depreciation of computers. Let's use shortcuts here. What was the value? I forgot. Let me double check. 9,500. So 9,500. And then remember to include this to get the new total depreciation now. Let me rewrite this. Okay, add 9,500 to computers depreciation. 17,000 plus 9,500, 26,500. Okay. This was the depreciation before this year. This is the depreciation during this year. Adding both gives us total depreciation till now. Moving on to the next one. Usually they give us 3 non-current assets in these questions. Let's zoom this out. Okay, fixtures and fittings. This is rough work. I can use shortcuts. F and F. This depreciation is done using straight line method. Straight line is very simple. It is simply cost multiplied by rate. So rate is given 10% and we can find the cost given in the question. The cost for fixtures and fittings is 15,000. We don't need net book value for this because this is straight line. In straight line method, you simply multiply the cost with the rate. So this is actually simpler than reducing balance method because we don't have to find the net book value. We can simply multiply the rate with the cost given in the question. So 15,000 into 10% is giving us, I think 1,500. Yeah. 1,500 is the depreciation of fixtures and fittings. Repeat the steps now. Now you should be fast. All you have to do is write down this as an expense, depreciation, fixtures and fittings. The amount was 1,500. And then include this in the depreciations till now to write down the total depreciation of fixtures and fittings after including the current year's depreciation to it. ठीक है, this is it. These are the new provision values you will use in the SOFP when you're preparing it. Okay, we are done with this adjustment as well. We have depreciated all the non-current assets one by one. We are done. Last adjustment. अभी cover की है हमने ये, but let's do this again. I have covered this in Sole Trader Part 2. Okay. Let me erase all this so that I have this space to do the working for adjustment number 7. Okay. The first thing that you should do when you read this adjustment, this is always given. The wording is always the same. Okay. Trade receivables of 2700 are irrecoverable. Only read till here first. Once you've read it till here, go up and deduct 2700 from trade receivables, because we are not going to get this amount from our trade receivables. So we have to write down the actual value of trade receivables, and for that you have to subtract the irrecoverable debt from trade receivables. 1 second. Okay. So the value of trade receivables is 44,700. Subtract 2,700 from this. 44,700 minus 2,700. 42,000. This is the value of my trade receivables. And then remember to include this as an expense in the income statement, because irrecoverable debts are an expense for the business. Then when your trade receivables are not going to pay you, this becomes your expense, because this will decrease your profits. Anything that decreases your profits is an expense for the business. Okay, so I've recorded the irrecoverable amount as an expense here in my rough section, so that I remember to include this in my income statement when I'm preparing it. Okay. Okay, let's read the next part of the adjustment now. The provision for doubtful debts is to be maintained at 5% on the remaining trade receivables. In some questions, they don't give you this. They only give you the information till here. The provision for doubtful debts is to be maintained at 5%. That's it. But you should know that it is maintained on the new value of trade receivables, even if they have not given you this. In this question, they have given us this, so it's fine. So the new value or remaining trade receivables are worth how much? 42,000. As you can see here, let me put this in a box. 42,000. So let's apply 5% on 42,000. 42,000 into 5% gives me 2,100. So the provision for doubtful debts is 2,100. I've told you what these are. Okay, please go back if you did not understand. It's in Sole Traders video part 2. Okay, go through that and watch it again. So 2,100 is the provision for doubtful debts. In the current assets section, record this here, less provision for doubtful debts, so that you remember that you have to subtract this amount from your trade receivables in the SOFP. Okay, write down the amount 2,100. Otherwise you might forget. But if you have done this rough work, you will remember to include this in your current assets section. Okay. Why this is subtracted from trade receivables? I have told you that. This is the expected amount you're not going to get from your trade receivables. Okay, so we have to subtract this to show the fair picture or the true picture in our statements. Okay. So now in the question, they have given you a provision for doubtful debts opening balance, which is this 1,400. Okay, in this question. So your opening provisions were 1,400. This is the expected amount. You expected you will not get this much from your trade receivables. Okay, so this was your expense. Now, in reality, or at the end of the year, you have figured out that you're not going to get $2,100 in reality. So is it a good thing or a bad thing? It's a bad thing, just discussed in the previous slides. It's a bad thing because the provision is increasing by $700. So now We expected our trade receivables not to pay us this much. In reality, now the expectations are that they will not pay us this much. So this is bad. It has increased. The provision for doubtful debts has increased by $700. When this increases, this will go in the expenses of the business as increase in provision. I'm writing in short, I don't have space, and this is my rough work. Increase in provision for doubtful debts, and then only record the amount which it has increased by $700 in this case, and that's it. This is it for the adjustment. So I'm done with all the adjustments. I will start making the income statement over here now. Okay, let me erase this. Let's start preparing the income statement. Let's move up. Okay. See, I have the question in front of me now. Preparing the income statement should be very easy for me. The heading is actually given in the question. They give you the format. You can use that. In CIEs, you don't have to write down the heading yourself. But for now, I am writing it. Okay. The name of the person comes on top, or I can simply just write income statement for the year ended and then just look at the date here. This is when the accounting year is ending. So 30th April 2017. This is the heading, but you don't have to worry about this. This is usually given. You just have to start making the income statement. They will give you 2 columns. Okay, let me zoom this in. See, you should be knowing the format of income statement by heart. If you don't know the format, please go through Sole Trader Part 1. Okay, I have prepared a video on that. Go through that first. We always start with sales. So I will write here. Let's start from here to keep it simple so that the values are not very far off. Sales. The first thing you start with is sales, and I've told you why in detail. Okay. Let's look at the value of sales given in the question. Let me move this here. Okay. Sales are worth 447,000. Okay. So I will simply record the value of sales over here, 447,000. The next thing we do is we subtract. In accounting, we write less whenever we have to subtract something. We subtract sales returns out of it. Okay, we had marked sales returns here. So I will simply write 8650 under this 8650. But remember to put this in brackets. In accounting, we don't use minus sign to show subtract. We just put brackets. Okay. Do the working for this. You will get net sales, or the actual sales your business has made during the year. This is the money you have generated by selling goods. Okay, you sold some goods. Some of them were returned back to you. So your actual sales were, let me use my calculator, 447,000 minus 8650. My net sales or actual sales are 438,350 Okay, these are my net sales or actual sales that I have made during the year. Now, the next section is the cost of sales section, less cost of sales. This is a subheading, so there will be no amount written in any column in front of this. This is just the subheading. What is cost of sales? Cost of sales is the cost necessary to make these sales possible, which simply means you have to purchase goods to sell them, right? So that's your cost of sales. Now I have explained the format in detail in part 1. Please go through that first if you don't know the format. We always start with opening inventory. Okay. The value is always given in the question. Opening inventory is worth 29350. 29350. Okay, in some questions, this opening inventory might not be given. That is only possible if it is the first year of trading. Okay, in the first year of trading, there will be no opening inventory because there's nothing left over from the previous year, right? So usually it is given, but if it's the first year of the business, which means the business has formed in this year only, there will be no opening inventory. So you will not even write the heading and directly move on to purchases. The next thing after opening inventory is that we mention or write down the amount of purchases. So again, let's look at the value from the question. Purchases are 211,900. We will not use the old value or the value given in the question. No, don't use this value. We make changes to the question so that we can use the new values to prepare proper statements. So 211,900. This is the value of your purchases. Next thing in the format is purchase returns, but I don't think there were any purchase returns in this. Yeah, no purchase returns were mentioned. So, and then there is also no carriage inwards, because according to the format, we have to less purchase returns from this. Then we have to add carriage inwards as explained in part 1. But if they're not given in the question, you simply skip the headings and move on. Then the next thing we do is less goods for own use, which is also not given in the question. We have looked at the entire question. There were no goods for own use. The owner did not take any goods from the business for personal use. Drawings are different. These are cash drawings, okay? This is not goods for own use. If the owner is taking home goods for own use, it will be mentioned with that heading only, goods for own use, okay? Not drawings like this. So let's move on. Then the last thing is closing inventory. We subtract closing inventory from this because this is the leftover inventory which remained unsold. So we cannot include this as an expense. We cannot include this as cost of sales because this will be sold next year now. This is not this year's cost of sales. Closing inventory is always given in the question, which is here. See, closing inventory 32450. So 32450. And in brackets to show that we are subtracting this, not adding this. Let's use our calculators and do the working for this. Second, let me write this 4 properly. Okay. So 29350 plus 211,900 minus 32450. The total I'm getting is 208,800. And I will put this in brackets because I have to subtract this from net sales to get my gross profit. Okay, let's leave some space to write the value of gross profit. Okay, so this is my cost of sales. This is the money I generated by selling goods. Okay, let me highlight this in yellow. This is the money I generated by selling goods. This is the cost of sales I had to pay in order to make these sales possible. So to find gross profit, I have to subtract cost of sales from sales. This will show me the profit I have made by selling these goods. Okay. So gross profit will be, let's subtract this. 438,350 minus 208,800. It gives me 229,500. This is my gross profit. This is the profit, sorry, 550. Okay, so this is the gross profit. This is the money I have made by selling goods after deducting the costs of purchasing those goods. Okay. Now, this is called the trading account section of the income statement because this only includes the buying or selling of goods. This part is the buying, the cost that you had to pay on buying those goods, and this part is the money you received by selling those goods. So this is the buying and selling section of the income statement, which is called the trading account section. Trading क्या होती है? Trading is buying and selling of goods. Once you have gross profit, you have to include all the other incomes of the business to this amount as discussed in part 1. ठीक है? I can also write add here to show that these amounts are added to the gross profit. Okay. About these two columns, this is your totals column. Sorry, this is your working column and this is your totals column. So you can simply write the total in front of the last object of that section. As you can see, closing inventory was this, and I've written the total amount of cost of sales in front of that here. I did not leave a line. You can simply do this. Okay, you can write the totals in front of the last thing. I will do the same in expenses and other incomes. So, do we have any other income in this? Let's see. When we were looking at the question, we were marking this, right? So let's figure out if we have any income in this. Yeah, we have one. See, I'm making a star to show you. I have marked this as an income. So now it's easier for me to simply write this here. Rent receivable and I have just one other income. We had no other incomes in this apart from rent receivable, so I don't have to use the working column. I will simply put the amount directly in the totals column. Let me zoom this out. What's the value of rent receivable? The value of rent receivable after making the adjustment to it is 13,000. So I have to use the new value. Remember, why did we made the changes to the trial balance? So that we can use the new values or the actual accurate values. That's why we make adjustments. So there's no point in using the old value, right? Otherwise, what was the purpose of these adjustments? We have to use new values. So I will simply write 13,000 here and add it to gross profit. There's no other income apart from rent receivable. So we can simply add this to gross profit there and then. 229,550 plus 13,000 gives me 242,550. ठीक है? So this is the total money made by my business. This amount was made by selling goods, and this is generated through other means, other income. So that's the total value now, 242,550. ठीक है? Now we have to list down all the expenses of the business. I've told you, apart from cost of sales, there are also a lot of other expenses of the business, such as salaries, electricity, and it depends from business to business. In this, we also have a lot of expenses. Okay, so let's look at them first. See, I have marked them here. जिसके भी आगे expense or E is written, you have to include that now over here in order. It's always better to include them in order. Even if you mess the order up, it doesn't make a difference because the final amount will be anyways the same. But it's better. It's easier for the examiner to check. ठीक है? So let's not irritate the examiner and write them in order. Wages and salaries should come first. One second, let me move my calculator here. Okay. So wages and salaries, 105,600. ठीक है? Here. Wages and salaries. Let's move this here and write down the amount 105. I will use the working column obviously because there are a lot of expenses. There's not just one expense. If it was just one expense, I will directly write it in the totals column. But we have a lot of expenses, so 105,600. Okay. Okay, one more thing. If you have made changes to the question, for example, this rent receivable was 8,500, but now it is 13,000. So also show in brackets that how you arrived to the new figure, 8,500 plus 4,500, so that the examiner can see that you knew what you were doing. Okay, it's always a good thing to write this like this. Okay, so whatever you have done here, 8,500 plus 4,500, also show this in brackets here. This is just showing your working. Okay, and then write the totals here. Wages and salaries, no changes were made to that amount, so we can simply write this here as it is. Then the next expense is motor vehicle expenses. Okay, let's just do it like this. Motor vehicle. Now we cannot use shortcuts. This is my fair work. I will have to write motor vehicle expenses. I cannot write MV. I can do that in my rough work, but not in the fair thing. Okay, so motor vehicle expenses are 19,200. Okay, I'm showing you with an arrow. 19,200. No adjustments were made, so it is here as it is. Then we have general expenses, and this is the amount before adjustments, and this is the adjusted amount. So I have to use 32,800. So I'm writing the amount here, 32,800 for general expenses, and then show the working in brackets that what we did. ठीक है, as it is, यहीं से copy कर लो. 31,100 plus 3,500 and then minus 1,800. We are showing them how we arrived to this figure. ठीक है, because this is our rough work. They might even not look at this plus and minus. They ignore this. ठीक है, we have to show the working here. After general expenses, we have rent receivable, which is not an expense. Rent payable is an expense though, so I will write rent payable. And what is the amount? The new amount. Always use new amounts. I have repeated that several times now. So 20,000 is the new amount. Show the working in brackets. It was 24. And then we subtracted 4,000 from it to get 20,000. Okay. Okay. Do we have any other expense after rent payable? SFP non-current asset. Yeah, heat and light. So record heat and light here. And there were no adjustments to this amount, so I will write down this amount as it is, 10,700. Now we have no other expense, but there's a bank loan given with a percentage. This is the interest rate. This is the amount. I have told you what to do with this. You have to multiply 80,000 with 5%. You will get 4,000 as the bank loan interest. Don't forget to do this because this is not given in adjustments. So you have to remember to find the bank loan interest and put it as an expense in the income statement. Now there is information given that how much out of this is paid. 2,500 out of this is paid, which means 1,500 is still pending or accrued. Include that as a current liability. In the previous slides we have discussed that. So bank interest accrued. Bank interest accrued 1,500. Okay. Now let's include all these expenses given. Sorry, not given, but the ones that we have found on our own through the adjustments. We have to include them as well. So let me move this here and copy them from here to my income statement. Very easy, right? This is the benefit of making these rough columns. Now I simply have to just record them from there and then. Now I cannot use shortcuts because this is my fair work. Depreciation of motor vehicle, and the amount is 5600. ठीक है. Now depreciation of computers. I cannot write CPU or use shortcuts now. So computers 9500, and then depreciation of fixtures and fittings. Depreciation of fixtures and fittings. I cannot write FNF or fix and fit. No shortcuts now. And the amount is 1500. Okay, after that we have irrecoverable debt. Irrecoverable debts worth 2700. And finally we have increase in provision for doubtful debts. Increase in provision for doubtful debts. And the amount is 700. Okay. We have recorded all the expenses given in the question, the bank loan interest as well, and then all these that we had calculated through adjustments. So now all the expenses are included in the income statement. Let's total all of these expenses now. Use your calculators, total them. Okay. Let's just look at the income statement now. Okay, total these expenses quickly. 105,600 plus 19,200 plus 32,800 plus 20,000 plus 10,700 plus 4,000 plus 5,600 plus 9,500 plus 1,500 plus 2,700 and plus 700. So you can see a business has so many expenses. Okay? The total value of these expenses is 212,300. So now this is the money generated by the business. These are all the expenses of the business, operational expenses of the business. So I have to subtract the expenses from the money generated to find the final profit of the year. Okay? So let's do that. 242,550 minus 212,300 gives me 30,250. This is the profit for the year, which we also call as net profit. Let's leave a line and write it here. So you don't have to leave a line, but now my subheading is coming over here, so I don't want to mess this up. 30,250. Okay? This is the net profit or profit for the year. Okay? Net profit. Why do we prepare income statement? To find profit for the year, and that's what we have done. Okay, so our business is profitable and we have made a profit of $30,250. So this is the money that my business generated by selling goods. Okay, these are the that's the money generated by sales. This was my cost of sales, the cost of purchasing inventory mainly. Then this was my gross profit, the money I generated on the sales I made. I included other income to this to get a new figure, and then I subtracted all the expenses of the business, which are the operational expenses necessary to operate the business, to get my final profit of the year. Okay? So this is what an income statement is used for. You can look at this, compare it if you were doing it with me, and then let's move on to the statement of financial position. Okay, this is the complete income statement in front of you. I will erase this and make the SOFP here. The only thing I need for SOFP from the income statement is the final profit for the year. So let's record it here. Profit is 30250. Okay. Now I can erase this. Let me make the SOFP quickly. In SOFP, we will use 3 columns. Most of the times we will be using only 2 columns, but for some things we will need 3 columns, mainly in the non-current asset section. Okay. Let me write down the heading. Case statement of financial position as at, and then the date, 30th April 2017. Okay, this will be given in the question. You don't have to worry about the heading. Okay, the first section in your SOFP is the non-current asset section. You should be knowing the format by now. Non-current assets. This is a subheading. Okay. You will need 3 columns in this. One for the cost of the non-current asset, the other one for provision for depreciation, or you can call it total depreciation or accumulated depreciation, as you like. Provision for depreciation, and then finally the net book value column, which is the actual remaining value of your non-current assets. Okay, so we will need these 3 columns here only in the non-current asset section part. Okay, these are these headings. All we have to do is copy the values from the question to here now. So what was the first non-current asset that we had? We had motor vehicle. Okay, you can look here. Let me move this here so that you can see properly. Okay, this is motor vehicle and the cost was 40,000. So I'm writing here. Let's write the cost of all 3 first. Motor vehicles. The cost is 40,000. Then we have computers, and the cost is 55,000. And finally, the third non-current asset is fixtures and fittings, and the cost is 15,000. Okay, now let's record their depreciation still now. So we need the new values. That's why we included the current year's depreciation to this old value, so that we have the new final values of total depreciation till now. So we have 17,600 for motor vehicles. I will write it here in provision for depreciation column. 17,600. We have 26,500 as the total depreciation of computers, and then 5,500 as the total depreciation of fixtures and fittings. We know what net book value is. Net book value is simply cost minus provision for depreciation. Okay? So we will subtract the provisions from cost to get the net book values. Let's do it one by one. 40,000 minus 17,600 gives me 22,400. So the net book value of my motor vehicles is 22,400. Computers, the cost is 55,000 minus 26,500 from it. I will get 28,500 as the net book value of computers. Fixtures and fittings, cost is 15,000. Provision for depreciation is 5,500. So the actual remaining value is 9,500. Okay? Now we have to use our calculators and find this value. So let's do that. You can simply make a line. We total all the columns, but the main column is the net book value column. Okay? But still, sometimes they give you a mark for totaling these other columns as well. So let's total all of these. 40,000 plus 55,000 plus 15,000 is 110,000. Sorry, let me switch to pen. 110,000. The total cost of our assets combined. The total depreciations were 17,600 plus 26,500 plus 5,500. 49,600. And the total net book value of our assets combined is 22,400 plus 28,500 plus 9,500. 60,400. The only important thing for us is the net book value. Okay? Even though we have totaled these columns, they are not of importance to us. The only important thing, let me mark this in red, is the net book value. This is the actual value of my non-current assets that I have in my business. So what do we care about? We care about the things that we have. This is the value. We don't care how much was the cost. Okay? Even though the cost was 110,000, it doesn't matter, because the actual value of these assets is now 60,400, and that is the value at which I will record my non-current assets in my books. Okay? And people are also interested in knowing the actual value of things, right? Now moving on. Okay, let's give the next heading, which is for current assets. This is a subheading, so no amount will come in front. We will basically use two columns, but we need the third column for just provision for doubtful debts, which I will tell you. But mainly this is your working column and this is your totals column. Totals, okay? This is for workings. Now, current assets. Let's include them in order of least liquidity, okay? Of decreasing liquidity. Means that the current asset, which is the least liquid, should come first. Even if you don't follow the format, it won't make a difference. Least liquid means how difficult it is to convert a current asset into cash. So inventory is usually your least liquid asset because it takes time to sell inventory and convert this into cash. Which inventory will come? Closing inventory. So 3, 2, 4, 5, 0. After this, we usually record our trade receivables, which are given in the question over here. Trade receivables are 42,000. Take a new value. Use the new value. So, but we will use the first column for trade receivables only because we have to less provision for doubtful debts from it. For doubtful debts. Take it to get the final value or the accurate value of my trade receivables. So 42,000 minus 2,100. $39,900. This is the value of my trade receivables. How did I remember to do this? Because in my current assets rough working, one second, over here, I had recorded this. So looking at this, मुझे याद आ गया, and I did this. That's why our rough work is so important. Inventory I also picked from here. I've picked this, I've picked this. Now I have to include all these as well. Okay? So let's include them. General expenses prepaid. Now see, there are two ways of doing this. What your examiner prefers is that all these receivables, these are called other receivables. They want you to simply total them. Okay, you can show it like this. You can write other receivables, other receivables. Okay, make a bracket like this and add these 1800 plus 4500 plus 4000. Use your calculator and total them. 1800 plus 4500 plus 4000. The total is 10,300. So they expect you to just simply write the total of other receivables combined like this. Okay? Even if you don't do that, it's fine. You can record them individually as general expenses prepaid 1800, rent receivable accrued 4500, and prepaid rent 4000. They cannot mark that wrong, but this is what they prefer, and also this is faster for you. This will save your time, right? So you can do it like this. Now, what else is left? Let's look at the question. Did we miss any? Current asset, we have marked all these. Okay, yeah. So cash and bank is left. And we will write down the new value, which is how much? 7900. Okay, 7900. But also show the working. I've told you, show the adjustment in brackets. What was the value of cash and bank? The cash and bank value was 15,400, as you can see. But then we subtracted 7,500 when we corrected the error. That's how we got 7,900 as the final or new amount here. Okay? So I've shown the working in brackets. The examiner prefers this, so it is better to show it like this. Okay, so we are done with all the current assets. This is the value of inventory. This is the value of trade receivables. These are my other receivables. And this is my cash and bank. Add these four together. 32450 plus 39900 plus 10300 plus 7900. The total value I am getting is 90,550. Please double check, okay? You also calculate this yourself and double check. Now, I'm done with non-current assets and current assets, so I can write the amount of total assets. How? By adding non-current assets to the current assets. Which value of non-current assets should I pick? The net book value. Okay, I've told you this is the only important actual value. So 60,400 plus 90,550 plus add both, you will get 150,950. You don't have to leave a line. Okay? I'm just leaving a line to show it clearly to you, but you don't have to actually leave a line here. This is the value of my total assets, 150,950. Moving on to the capital and liabilities section. If you don't know the format, go through part 1 of Sole Trader first. Capital and liabilities. Okay, the first thing, now we can just simply use two columns. The first thing you have to write here is the value of opening capital, which is given in the question. Let's see, this is 30,000. Okay, so capital 30,000, we less drawings from it, as you know from the format. What's the value of drawings? 31050, and this was capital, just to show you if you did not recognize. This is 30,000 capital, these are drawings 31,050. 31050. Drawings are subtracted from capital, so put these in brackets, and then profit for the year is added. Profit for the year, which we get from the income statement. I have recorded it here, 30250. So 30250 will be added to this. So 30,000 plus 30,250 minus 31050 will give me the final or closing value of capital. So let's see, 30,000 minus 31050 plus 30250. 29,200. This is the value of closing capital. Now, non-current liabilities. Next subheading. Okay, let's see, did we mark any non-current liability in the question? I remember we had one. Yes, this bank loan, NCL. Let me show this in red. This one, this is payable in 2022 and we are in 2017 right now, so it's a non-current liability. So I will write here bank loan. Also write when it's repayable. Repayable 30 June 2022. And then the amount of the loan, which is 80,000, not the interest but the actual amount of loan. We have just one non-current liability. I can simply use the totals column. Moving on to current liabilities. The most common current liability is your trade payables. So let's quickly mention that first. Trade payables. And let's look at the value from the question. 36750. Here, let me show it to you. Trade payables 36750. Okay, now we have to also include all these current liabilities we have kept in rough work. So we have just two here. You can write them as other payables, just like other receivables in current asset. You can write other payables and in brackets you can write the values. So general expenses accrued are 3,500 and bank interest accrued is 1,500. Add both. You can also show them individually if you want, but this will save your time and this is acceptable. So we can do this. So this comes as 5,000, right? And did we have any other current liability? Let me double check. Okay, this is from our rough work. And is there any other current liability in the question apart from trade payables? No. So that's it. Okay, let's zoom this out. This is the total value of my current liabilities. I will add these two. So 36750 plus 5,000 gives me 41,750 as the total of current liabilities. Now, one second, undo. Zooming this in. The final thing we need is the total equity or capital and liabilities. Okay. Total all these. This is the total of capital. This is the total of non-current liabilities. This is current liabilities. Add these three. 29,200 plus 80,000 plus 41,750. So the total of capital and liabilities is 150,950. Okay. And we are done with the statement of financial position. See, if you have done everything correctly, the total of your assets, which is this, will be equal to the total of capital and liabilities, which is this. Okay? These both will be equal because the accounting equation states that assets should be equal to capital plus liabilities, chapter number 2. Okay? If you don't know that, please go through that chapter first, cover your basics first. Okay? But it is very difficult to balance. You might miss something, especially if it's a 40-mark lengthy question, even though you don't get those anymore. But you might make a mistake somewhere. A simple calculation error is enough to not make it balance. And then if you even mess up the income statement, it will not balance. Why? Because this profit figure is picked from the income statement. So if there was a mistake in the income statement, this figure will be different and then it will not balance. So any mistake in the income statement or SOFP will result in this not balancing. So don't worry about balancing. Just try to do as many things correctly as possible. Okay? Follow the steps, know the rules. And even if it's not balancing, there's no mark for balancing this. First of all, no mark. Okay? This just shows you that you have done this question correctly and you're getting 40 out of 40. But there's no mark for balancing this. So don't worry about balancing. Okay? Don't mess up other things trying to balance this. Just have confidence in yourself and know that you've done as many steps correctly as possible. Okay? And you will not even get a lengthy question like this anymore. This is a lot of things covered within one question. So please go through this again. I will also solve other questions on this individually and upload videos on that. But for now, you can rewind and look at this question again. It will take some time to understand this. It is not easy at first, but once you get a hold of this, this will help you in the coming topics. So this is very, very important to learn. And if you know this, accounting will get very easier for you in the coming future. Even in ratios, this will help you. This will help you in manufacturing account, partnership, limited companies, clubs and societies. So this is important. And the thing is, even though it looks difficult at first, it remains the same. The only thing they can change are the values and slight changes to the adjustments. So if you know how to do this once, if you cover, let's say, if you solve at least 2 or 3 questions, you will be able to do any question that comes in your exam. Okay? So practice is very important in accounting, just like in maths. So keep practicing. I will also upload other questions. You try to do those questions yourself first and then look at the solutions. Thank you very much. That's it for this topic. We have covered sole trader with adjustments in detail. If you have any questions, you can ask me. You can send me a message and I will help you with any problems that you have. I can also make a specific video to cover the part you are having problem with. So let me know.